Kalshi's bold move to double down on commodities arrives as a turning point for investors watching raw materials from copper to wheat. A dedicated commodities hub and a wider market footprint promise faster access, tighter spreads, and more diversified price discovery for both institutions and retail traders. With volatility fluctuating across energy, metals, and agricultural cycles, the shift could turn daily price moves into clearer signals. In an era of supply chain stress and policy shifts, risk managers crave transparent tools. This expansion could reshape hedging, speculation, and delegation of capital toward tangible assets at a critical moment. Traders may finally price complexity with clarity. Kalshi is expanding beyond simple binary bets to build a dedicated commodities hub that aggregates contracts across energy metals and agricultural goods. In practice, this means more price points, more contract types, and easier access for traders who want to hedge risk or speculate on directional moves. The platform will connect buyers and sellers with standardized rules, transparent margins, and faster settlement cycles. For investors, this changes how price discovery happens, creating a centralized venue where shifts in inventory, policy signals, and macro shocks can be priced into one coherent stream. In short, more choice, more liquidity, and clearer benchmarks for commodity markets. Traders respond with discipline and curiosity today. To understand this move, we trace commodity trading back to coffeehouses in the 17th century and later to organized exchanges in the 1800s. The modern era saw digitization, standardization, and breakdown of barriers between hedgers and speculators. Kalshi enters an arena where regulated exchange-style rules blend with crowd-based betting markets. Prior attempts at expanded commodity contracts faced liquidity gaps, regulatory hurdles, and complexity costs. The new hub borrows from futures market architecture while promising simpler interfaces for everyday investors. If past iterations struggled with trust or access, this time the goal is inclusive, transparent, and strictly governed globally. Price action across commodity sectors is already signaling appetite for new tools. Early trading whispers show tighter spreads for key benchmarks such as Brent, WTI, copper, and soy, amid anticipation of broader liquidity. Banks and brokerages assess potential flow shifts as Kalshi formalizes the hub, watching open interest and implied volatility move in tandem with policy chatter. Hedge funds may overlay risk parity bets with simple hedges, while retail portfolios could gain access to benchmarks that previously lived behind costly gatekeepers. While volatility remains elevated, the prospect of more participants could push volumes higher and democratize price discovery today globally. Big end users across energy, agriculture, base metals, and manufacturing are the obvious beneficiaries, alongside asset managers and swap dealers who thrive on hedging complexity. Airlines hedging jet fuel, farmers locking in corn margins, and manufacturers safeguarding copper inputs could gain clearer insurance against price swings. Exchange-traded funds and pensions may see new trackers tied to commodity baskets. Regulated brokers and fintechs wrapping Kalshi contracts could unlock simpler access for mom and pop investors. However, incumbents guarding legacy rails may resist, fearing disrupted fee models. In short, a broader toolbox reshapes who bears, transfers, and benefits from price risk. Macro tides are the undercurrent shaping this shift. Inflation dynamics, central bank policy, and supply chain resilience determine how quickly new hub liquidity translates into real hedges. For energy, geopolitical frictions push volatility higher, while agribusiness faces weather shocks that tighten pricing. Kalshi's hub could attract cross-asset bets that bridge equities and commodities, enabling risk premia to move with dollar strength or weakness. China growth cycles, European energy security, and US dollar liquidity all interact with exchange rules. In this ecosystem, regulatory clarity and capital adequacy become mission-critical to sustain durable participation. Policymakers watch, investors listen, and markets price readiness. Smart money is testing the water with tactical allocations and monitoring indicators. Banks and hedge funds may deploy modest position edges to capture new liquidity, while risk teams chart correlation paths between energy, metals, and currencies. Some pension funds are exploring long-duration commodity baskets as inflation hedges, while DIY investors hunt for accessible benchmarks and transparent costs. Kalshi's hub could simplify onboarding, reducing counterparty risk and margin requirements. In practice, this means more institutional whispers around margin calls, settlement risk, and governance, alongside a growing chorus of retail buyers chasing easier, real-time exposure to tangible assets. The net effect is subtle credibility gains and broader participation. Any expansion depends on disciplined risk controls and credible marketing. If liquidity fails to materialize, spreads could widen, friction costs rise, and users lose confidence in settlement reliability. There is also the risk of regulatory overreach or shifting rules that complicate compliance for smaller traders. Over-reliance on binary contracts may encourage crowding into single themes, amplifying levered bets during stress. The history of new venues shows that enthusiasm can outpace adoption, leaving dormant contracts and eroding integrity. Finally, if data feeds lag or governance falters, price discovery can diverge from real-world inventories and policy signals. Investors should stress test scenarios and demand transparent performance metrics. Retail traders can approach with education and discipline. Start by comparing fee structures, settlement times, and contract liquidity across platforms before piling into any single commodity. Use small position sizes, set stop losses, and diversify across energy, metals, and agriculture to avoid overconcentration. Track real-world indicators like inventory reports, weather surprises, and policy hints that often move prices faster than news. Practice paper trading on the new hub to understand contract mechanics without risking capital. Finally, resist hype, seek trusted sources, and balance risk with long-term exposure to tangible assets you can hold or hedge. Stay patient as markets learn. Looking ahead, Kalshi's Commodities Hub could accelerate a broader shift toward on-chain style price discovery in traditional markets. If the project scales, expect tighter liquidity, new risk transfer tools, and easier access for diverse players. Regulators will test adherence to investor protections, while tech providers optimize settlement efficiency and transparency. The macro backdrop remains volatile, with commodity cycles and policy moves shaping returns. For long-term enthusiasts, the lesson is clarity over speculation. Stay informed, diversify across sources, and evaluate risks against fundamentals.